talk about the specialness, which is actually the core of this lecture. This is why when we say spatial, why financial institutions have some characteristics that make them do things better than us. Why, when they go to the market, I'm an investor and they're an investor, but they do better than me. They provide services to me as a customer. They provide what we call it general areas of spatialness. And then we provide also an institutional specific spatialness. Now, there are 9 areas of spatialness, which means uniqueness. They are so unique in providing those services. One of them is the information cost. I will talk about them in details. And actually, I told you this is the core of this lecture. So the first one is the information cost. Somebody would say, what do we mean? Yes, when we want to invest, actually, we don't go and invest in anything. We have to invest in the right corporation. And when we want to invest in the right corporation, we need to collect information, analyst information, financial statements, do some types of, analysis, evaluate the performance of all those corporations, and then we decide. This needs information. Collecting information is costly. If I'm going to, I tell you, invest for 1,000 ringgit or 10,000 ringgit in Simon Therapy, I cannot go by and, financial analyst reports and follow the financial statements. It will take time. And even if I outsource it for somebody else, it will take time and effort. Financial institutions can do it easier because of the economic of scale. Now, this economic of scale also applies when we are talking about transaction cost. The transaction cost is also cheaper for them because they do it because of this issue of economic of scale. So if you buy, they buy in bulk, so it's actually cheaper for them. So this also what we call economic of scale too. This is 2 things, they do it better than us. Now I'm telling you where they are unique. They are unique in these 2 areas because they can collect information easier and in more efficiency. They can also minimize the cost of their transaction cost. Now, the other thing is the liquidity and the price risk. There is no liquidity and the price risk. Let's agree on that. I already explained it. Why? If I want to liquidate my money, the bank will give me my money. They will honor my liquidation. I will give you an easier example. Your parents are giving you 1,000 ringgits, say the expenses. You put it in the ATM machine. If you want to withdraw it after 5 minutes, you can do that. But if you go and buy stocks and bonds, and you want to liquidate 50% of it, you cannot do that easy. You have to go, you have to talk to your broker until the market opens, it's a transaction. Now we are talking about this 1,000, but we can talk also about 10 million. It's the same concept. So actually, they can honor your liquidity. This is one thing. The same thing, you bought 1,000, they will give you 1,000 with some return, fixed, already known. So there is no price risk and liquidity risk. But if you go and you invest in stocks or bonds, the price risk is there. You can lose your investment, and you cannot liquidate very fast. So this is the 3rd thing, which is, as I told you, this issue. Okay. Now, maturity intermediation. Maturity intermediation is a very nice concept. What do we mean by maturity intermediation? I receive a deposit. For example, if I'm saving, say, 2,000 or 3,000 ringgits of my salary and bought it in the bank. Now, they take my money. Maybe I'm saving it. I want to travel, or maybe I want to buy a new car, or want to do some other things. They take all this money, which I will need it maybe next month, or even they take your money, which you just put it today, and you will, this 1,000 ringgit you received from your dad or your parents for the expenses of the month, and you are going to spend it by the end of the month. They take my money and your money, and they give it to somebody else who wants to buy a house. And this guy will give their money in 20 years. This is like crazy. It's like magic. This maturity intermediation, they receive this is the right term. They receive a very, very liquid liability, like deposit, and in the same time, they invested in a very, very illiquid asset. How do they do that? We will talk about it later on, but actually they do it. This is why the banks are unique. Now, this is actually 1, 2, 3, 4 is what we call the general areas of specialness, or you can say the micro issues, the micro perspective. Now, which is these areas. This is the micro issues. Now let's go to the the other services they do for the economy. They do the transmission of monetary supply. So the money supply is actually central banks are doing all those issues of the transmission, shrinking the cash in the market, or increasing the supply of money or decreasing the supply of money. They do it through interest rate. So financial institutions actually reflect that, because I can increase the interest rate in the bank. And then in this case, every depositor will be actually happy to deposit his money with me and will be motivated. And then I can take all the cash from the market and say tackle or deal with inflation. If I want to stimulate the economy, which means I need more money supply, central bank will tell me, okay, we decrease the interest rate. So we decrease the interest rate and they say, okay, deposits I used to give 5% to 6%. Actually, we are giving now 1% or maybe 0%. Everybody will take his money and go and invest in corporations, whatever. So increase the money. All of this is happening through the financial institutions, but this is a micro. This is a macro. This is a macro, as I told you. This is a macro issue. From here to here is macro issues. The second thing is the credit allocation. Now, like the US, Australia, even Malaysia, UK, they want, in Australia, for example, they want the corporation to invest more in agriculture and also in housing loans. So they provide some subsidies and they provide some tax exemptions for the financial institutions for those loans. So you, instead of investing in derivatives or financial securities, I say no, invest in housing projects, or invest and increase the housing loans, because that will stimulate the whole economy, or in some disadvantaged industries. One of them could be or sectors, one of them could be agriculture. The other thing is the intergenerational wealth transfer. This is a new concept maybe for you. I'll explain it in the next few slides also, but this is like insurance company. So if I am an insurance company and I have a life insurance and it's for me, and this will stay with me until 80 years. And if somebody, for example, if the holder of the insurance is going to receive 2 million or 3 million ringgit life insurance if he dies before the 80. So if he dies, they will give the 3 million to the family, which is actually the kids, the younger generation, so they can survive, study, and do all those things. And this is actually a way of transferring the wealth from this elder generation to the younger generation through the insurance, life insurance policies. The other thing is the payment services. Payment services is a very interesting issue. What do you mean by very interesting issue? We have international payments. We have local payments. This is ATM, one of them. Now, FinTech and all those starts up and all those platforms and all those wallets, all of them, all these payment services internationally, or either the FinTech or either the platforms, all need banking account at the end. And so the payment services is actually facilitated through the financial institutions. Financial institutions, then there, it's really a problem. I issue a check from a bank because I'm a customer of a bank to somebody who's a customer in a bank. I pay, I want to import from China. I have to use the banking system to transfer the money from this country to that country. I want to open a letter of credit. All of those things, we will talk about it later on. And finally is the domination intermediation. And this is very interesting issue also. See, there is some sectors as an individuals, we cannot do it. For example, investing in mutual funds or investing in sukuk or high issue bonds. Sukuk in this country, for example, or bonds, they need you to pay 5 million for one slot. They don't give silly, you know, if you have 1,000 you want to invest, they're not really going to give you. The foreign operations, foreign exchange operations, which is the currencies, this is controlled by the 5 big boys in Europe. And if you want to go in that, you know, lots, one lot is 10 million ringgit, $10 million. So, but they are very, the return is very rewarding. So I need somebody to wait for me. So they will collect my money and your money and every investor money and make it as a big, you know, bulk of money. And they can enter and receive this actually high return, you know, investments, and which I can't do it alone. So as you can see, all those 9 areas make the financial institutions do things that we can't do it alone if we go to the market. And this is what we call it the financial institution specialness. This slide is very important. This slide and this slide is actually very important. Now, the next 10 slides actually is explaining all of those issues, and I will go over it very fast. So for the information cost, we already explained it, but why do I need information actually? Why I need information? I need information to make monitoring. So if I want to make monitoring, why I should make monitoring? Why I should watch the corporations who are using my funds? Because there is something called agency cost. And what is this agency cost? Agency cost is coming from the concept that there is a separation between the owners and the managers. So the shareholders have no control over the managers. And therefore, those insiders, which is the managers, tend to use or misuse the funds unless they are controlled, unless they are watched or monitored. So in this case, the agency cost is actually a problem created between the principal and the agent. Who is the principal? Is me. Who is the agent? Is actually the corporation. The corporation is taking my money, so they are the agent. And the principal, I'm paying that. So if I go to the market, I'm telling you, agency cost will be there. I will have to sacrifice my money. If I'm investing, I have to sacrifice some of my investments because of the misuse of the managers inside. Of course, some of those corporations are very, very profitable. Sometimes you cannot feel, but there is misuse if they are not monitored. Now, somebody would say how the financial institution will solve the problem. As I told you, the agency cost is solved. First, as I told you, because they will build up, buy all our money, and then they will resolve this problem because they can sit now in the board. So the financial institutions, now have greater incentives for information collection. They have greater incentives and they are actually cheaper because they are actually working as an agent for all those principals or all those depositors. So actually, they are like financial, what we call institutional investors, and those institutional investors, actually, some of them sit in the board of companies. When they finance companies, one of the conditions or the covenants, which I told you last time, is we will participate in the board. And they have a voice, and they have a vote, and they can actually collect inside information, and they can also control. So there is another concept I want you to be aware of, which we call the free rider problem. What is the free rider problem? If I go on and invest a loan in the market, say I have 10,000 ringgits. I know some other people or investors coming from the Middle East, maybe they invest 10 million. And somebody is investing 5 million. And somebody come from Korea and Japan or whatever. So everybody is investing. So the way I'm thinking is, and this is the psychology of each investor, is why I have to do the monitoring. Why I have to go and follow and talk in the shareholders committees and, write letters to the management, whatever. While those people who are coming from the Middle East or from the Korea, they have more money and they can do that. So the Korean will say, well, the other investors will do. So every investor think from the perspective of free rider, he think, okay, other people will do, but nobody is doing. Actually, everyone depends or assumes that the rest of the investors are doing, and they act like a free riders. And this free rider problem happens. At the end of the day, nobody is investing. Nobody is monitoring. But when we invest through financial institutions, this free rider problem actually is solved. And how is it solved? Because the financial institutions actually will take this monitoring and operate as a delegated monitor. I want you to understand this word called delegated monitor. We usually see it in so many what you call tests. Okay. There is some also thing related to this information, which is very interesting. Now, when we develop to the new secondary securities, which means when I receive your money as a deposit, I can invest in primary securities, which is securities issued by others. But at the same time, I can also take all these deposits and issue a loan. And this loan, like what? It's like a business loan. So when I issue this secondary security as a business loan, I issue a secondary security for you as a deposit. And I issue a secondary security for like a loan, and give a loan of 1 million for some business. But in the same time, when I give that loan, I will have all those conditions over the borrower, which I can collect information and monitor. So the monitoring now is coming from the incentive and coming also from issuing secondary securities. So they have incentive because they are acting as delegated monitors. They are actually taking the information and also they are issuing secondary securities, will give them more monitoring. So if you look at this issue within the issue of information costs, you will see the agency cost is mitigated or decreased or minimized when we are talking about financial institutions. End of the day, I want to say collecting information about issuers and borrowers, user of fund is a very important function to decrease agency cost and improve monitoring. Please, when we talk about this, think about the free rider problem, think about delegated monitors, and think about the secondary securities issued. So all of those actually increase the monitoring. And when I increase the monitoring, I decrease what? I decrease the agency cost. Okay, this one is actually, we have talked about it. Now I'm only explaining those issues, okay? But I'm going to a little bit other issues. Here we are talking about financial institution provides secondary claims, which means liquidity, high liquidity, which means they honor your withdrawal anytime. Financial institutions are able to diversify. Why this is happening? Because the financial institutions, when they invest in housing loans, they invest in interbank, they invest in short term, they invest in long term, they invest inside the country, outside the country. They invest in all these huge portfolio of their portfolio and when we go to tier 3, you will see how you can develop a portfolio which make it all the time profitable, and in the same time make it all the time able to provide liquidity. And because they have all these sources, they can keep some type of liquidity which can serve unexpected withdrawals. So whenever you want to withdraw your money is there. Why? Because they are investing in so many areas where they can always get cash. This is an example. Bank can offer highly liquid demand deposit while investing in risky loans. Why? Because of diversification. So diversification benefits available as long as the intermediary needs to be large, actually. Small ones, very small. In this country, we have huge banks like Public Bank, like Maybank, like and outside this country, we have the huge banks. It's easy for them to diversify for liquidity and also for the price risk. Small banks, actually, they have problem because they don't make actually big diversification. They can't make big diversification, so they are under default risk, which means credit risk. They can lose, and also they can go to liquidity problems. They can be more highly illiquid claims. Okay, so this diversification is actually depends also on the size. Okay, this already we talked about it. The transaction cost is decreased. Why? Economic of scale. And this is what we are talking about. Maturity intermediation, we already talked about it, which is the ability to bear the risk of mismatching, which means here you issue liability deposits, which is short term. And you receive a short-term deposit. This is what we mean, and issue long-term. So when we talk about maturity intermediation, is the ability to do this, the ability to be able to manage the mismatch between this very short-term deposits, like my deposit and your deposits, which is saving accounts or even current accounts, and the long-term deposits, and long-term loans, which is 20 years. So you are talking here about 1 year, and you are taking here about 20 years. So the maturity intermediation function is also based on diversification. So to give you an example, financial institutions are able to produce new types of contracts like long-term mortgage loans to households while still raising funds using short-term liability contracts, short-term deposits. Therefore, financial institutions provide maturity intermediation to the rest of the economy. Nobody can do that. Nobody can do that. Just take it from me. And of course, when they do that, they go to diversification and they go to very, very serious planning. And this is why they bring liquidity to the whole economy. Okay. So understand the maturity intermediation from this concept: short-term and long-term, receiving short-term liability and buying paying what you call long-term deposits, long-term loans. Okay. Let me go to the transmission of money policy. We already talked about it. This is actually a macro level. And when we talked about macro level, this is the what we call institutional specific specialness. So financial institution most widely used to medium exchange. This is when we talked about the money supply, controlling the money supply. And this is the right statement to read because the liabilities of depository institutions are significant components of monetary supply of the money supply that impacts the rate of inflation. They play a key role in the transmission of money, a monetary policy from central bank to the rest of the economy. The depository institutions are the conduit, which means the channel through which the monetary policy with the actions impacts the rest of the economy. Impacts the rest of the financial sector and the economy in general. Okay. I already told you they use interest rate to either attract deposits or attract the depositors or motivate or demotivate the depositors. This is what we mean by the transmission of the monetary policy. You can bring so much cash to the financial institutions, or you can shrink the cash supply in the market, or you can increase the cash in the market by leaking all this cash inside the institutions and put it in the market. Okay, credit allocation, we already talked about it, but as I told you, US and UK encouraging actually financial institution to work in housings because they think housing is very important. And this is what we call it, they call it special need of finance, which is the housing sector. In Australia, they have the finance, the real estate loans encouraged, but also the agriculture. And I think the agriculture sector is very important because it provides an overall social welfare to the population. Now, after that, we go to the intergenerational wealth transfer. And this, as I told you, what the insurance companies are doing, life insurance companies actually, when they transfer the value of the policies for those people who pass away to their springs and to the families or the kids, and to the next generation. Okay, payment services, I want you to understand it. Actually, payment services, wherever you go to any country, you will find different settings. In Malaysia, we have what we call MEPS, Malaysian Electronic Payment System, MEPS, and you can see it in some of the ATM machines. Now, in Australia, we have EPSA, which is Australian Payment Clearing Association. Now, those associations, you can have so many different names, but actually the regulator, for example, Bank Negara will establish these payment systems. And those payment systems, in Australia, for example, EPSA manage checks. So if I issue a check and I am a public bank customer for 10 million ringgit today to some other businesses, which is HSBC, now there is a system through the central bank where they can clear those checks. Okay, if we are talking about ATM machines, you can withdraw from any ATM machine, and finally they can settle between the banks. Now, even when we talk about the wallets, talk about any wallets, PayPal, all those wallets, they also have their own system to settle those things. If you talk about international payments, also they settle this international payments through what we call the letter of credit, protocols, and you can do all of those through the, the international payment systems. So, if you talk about the local things, you can talk about clearing the checks, direct entry payments, the payments of the ATM machines, the debit cards. Debit card, I can scan it now, or buy from it through scanning or whatever from any of those stores, regardless where their bank is, and then they clear it later on. And we have the high value payments. Now, high value payments, which is payments between the interbanks. You are talking about 50 million, 60 million, payments. I think in Australia up to 30 million. So in this case also, there is another payment system. EPSA actually in Australia do that. and clear those amounts. So there is also some payments which is not actually cleared through the other payment services. For example, in Australia, you have credit cards and pay. This is out of IPSA. I mean, this is not a big issue. Those regulation and arrangements or whatever can change anytime. And we have the buying and selling of securities. When we buy bonds on stocks in the market, there between the brokers, there must be, they make it on the system, buying and selling now, but there must be some settlement. Settlement has to happen later on, where they transfer the ownership of the bonds or shares and the Security Commission. And then in Australia, they have Austria Clear, or the CHESS. CHESS is a clearing house, electronic sub-register. This is actually to settle the buying and selling of securities within the country. Okay, so this is the payment system. We already talked about domination and intermediation, but as I told you, if you look at investment in money market funds, debt equity managed funds, unit trust, or even big forex, then in this case, as individual investors, we cannot do that. But the banks and the financial institutions, since they are large and they have huge funds, they can actually participate in those ones, and they can get that return and distribute it to us. So the point here is individual and the small investor can overcome the constraints in large dominations, which means investments that give high return, but needs high funds. And by that, we can get an access to large domination markets. Now, as you can see now, when you look at those 9 functions, you can see, yes, the financial institutions actually have a point when they say they are special.